Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to James Thorne of Columbia Threadneedle, one of the UK's finest investors. So welcome, James.
Good morning.
Good morning. Well, just given the sort of the recent new lockdowns in Holland and Austria, alongside the sort of the concerns over rising bond yields and inflation expectations, what's your sort of view for equity markets as we look into 2022, particularly your sort of sweet spot of sort of small, micro and mid-cap stocks?
Yeah, I don't think there's been a huge change in view since we last spoke. I think it's pretty positive, really. I mean, I think COVID is going to come back in waves over the next couple of years in certain ways, as we've seen in Austria, as you say, in the Netherlands. I think one of the great things about UK small and mid cap is that we are on a great valuation versus our European and US peers. We are at multi-decade lows in relative valuations, and that it's even adjusting for the fact that there is a different composition, and everyone always highlights the fact there are loads of technology businesses on very high multiples in the US, but there is a lot of value, and we've seen that because we've seen a lot of M&A activity in the UK. I mean, as to interest rates and the yield curve, look, I mean, the Fed doesn't know. We don't know how transitory it is. I think the key thing is to protect ourselves in terms of investing in really good quality businesses. And I mean good quality in terms of the way the businesses are managed, and we've seen that in the way that companies, our good companies, have delivered during this period of difficult turmoil in supply chains, and those companies that aren't on top of it haven't delivered. And I think ultimately, if you are worried about inflation really picking up, I'd be much more worried about being in bond portfolios or fixed income than I would be necessarily in smaller companies that ultimately will grow very substantially and will be able to pass a lot of that inflation on, and that ultimately will give you a huge amount of protection in a much higher inflationary environment.
Oh, yeah, I mean, I totally agree with you. I mean, I haven't got a single bond pound in my portfolio, that's for sure. And my cash holding's down to 3%. And but other than that, it's totally long, largely small and mid-cap equities in sort of UK stocks, which do actually have some US exposure. So you raise a really good point, though, in terms of where to find opportunities. If there are a lot of value out there, you say obviously move into the sort of quality. How would you define quality small and mid caps? Is it sort of like into that sort of like with pricing power? How do you, with USPs? I mean, how do you define a good quality small cap?
I mean, it's interesting, really, because I think I'd start with one point in that, supply chains have been really important at the moment, and we normally refer to quality as meaning sort of high returns, stable high returns. That's a quality business, and obviously we're looking for that. We're looking for businesses that have got, you can charge a high price for your services, your products, and you're going to be able to charge high prices next year and the year after, and that market's growing. That is ultimately the sweet spot, but everyone's looking for that sweet spot. And if it's hot right now, everyone knows it's hot right now, and quite often they put it on a very high valuation. The other thing is you have some companies that are certainly project themselves as having those metrics and become hot right now, and ultimately the market at times suddenly realizes they're not. And usually the great sort of, if I always think of like, cooking disasters of my past, you cover it up with some really nice gravy, and the sort of the gravy, the thing that delivers the difference between intrinsic value and the share price is earnings momentum. If you just have earnings momentum, but you don't actually have these real building blocks of quality, ultimately you'll get found out. The cookery underneath is not very good. You've covered it up with gravy, with earnings momentum. And so, that's the thing you've got to be careful about. But I mean, back to supply chains, we've seen businesses that you'd consider to be, we're very proud to be invested in. They're good, solid businesses, but they're not in that very high quality bucket. And the difference between those businesses that have got, really good procurement departments, they've really thought about the supply chain, they've got lots of suppliers, they've got really good relationships, but also they've got really good relationships with their customers. So when they're going, oh, look, we're going to have a price rise in 6 months, they've gone to their customers, look, can you give a bit more of a commitment to your orders? So we can put that in the order book, but also we can go and tell our supply chain and secure all of that product for you. And that's meant businesses that you wouldn't necessarily put in that high quality bucket are actually behaving like really high quality, sustainable businesses.
Well, I did see actually, just talking about sort of high qualities and sort of strength of brand, etc. You've got one in your portfolio. In fact, I think you probably may have. Is Joules, which I think is sort of like it's a retailer with a a brand which does sort of like garden wear, or it's a really sort of heritage brand, but its gross margins are about 50%. So it's obviously a very, very good quality stock. Can you just talk about that one, because it's obviously reasonably valued as well.
Yeah, I mean, I think it's an interesting business. I mean, I live in East London in Hackney. So when Joules came about, and it's sort of born in sort of country shows and in the countryside, I kind of was like, okay, I've got to reconnect in this. But I was actually brought up in the countryside in the New Forest, and I think they've done a really good job of building proper brand strength. And the thing with these things is you build them slowly. And this business has been around for 30, 40 years, and it's got a real differentiation in lots of components of the product. They own that IP, all of the prints. They have quite a lot of floral prints and things like this. But they've also really connected to their customer base and their lifestyle. And so it's become slightly different to being a retailer, but also they've done everything really well. So they've invested really heavily in the business. And whether you want to go in a store or whether you want to shop online, they've got all that available to you. But they've really built a relationship with the customer. A lot of these customers have lots of animals, have lots of pets. They do live in the countryside. It's not just exclusively for that. And this resonates not just in the UK, but also in lots of other international markets. And it started to build a very strong presence in Germany and the US. But I mean, during COVID, this business performed incredibly well because it had invested very much ahead of revenue growth, but it could move all of its customers online, and because they had that really strong customer relationship, they built that incredibly well. And what's surprising is the share price has really not reflected that the share price has really knocked the shares, and it's incredibly cheap. And to the point, it quite surprised me that we added to that high, we continued to invest in that high quality name because we were surprised about how lowly valued it was, really.
Yeah, no, I mean, I'd point investors have a look at it because it's less than 1x sales, which for sort of a 49, 50% gross margin type of business is pretty good. And presumably, as the world reopens and people again sort of like spend more time outside with their wellies and barber jackets and stuff like that, then it's going to do pretty well, I would have thought. I did notice actually you've basically switched some of your other holding in an online retailer, N Brown, who I know Andy Bruff absolutely loves, but it's even rated cheaper. But you've switched out of that and sort of like cashed out of that position. Do you want to tell us how you sort of define because obviously you're looking for quality, high quality brands and stuff like that, and obviously that you prefer to put your chips in other areas, I guess.
Well, I think we want to keep the fund nice and focused, and it's competition for capital. We have lots of stuff sitting off the bench as well as those we've got invested in. But, when names that you hold, become very cheap, you kind of want to take an opportunity of that. And so there's competition for capital. And, there's a difference. I think there's lots of opportunities at M Brown in the medium term. I think the business has some really strong attributes, but it's also got some things it does need to sort out. And conversely, Joules doesn't have any of that. The business is delivering today. And so, we took the view that we had almost that opportunity. And so we took it. So it's not to say, one or other is a better business, but which one is sort of in a stronger position at the moment, then we take a view.
Yeah, I did see with M Brown's got a pretty heavy debt load, hasn't it? It needs to sort of like a last count, I think they're projecting 275 a net debt position.
Yeah, but to be fair, that's not their debt. They use that. That's effectively a lot of their customers, but buy their products on credit, and that effectively is a ring-fenced account. Yeah, so it's not fair to say that is the debt of the PLC.
Yeah. But essentially what you're doing is when you look forward into 2022, you're sort of like going for the high, because you can, because it's still cheap, it's still good value. You're sort of like refining that sort of that quality portfolio.
Well, I think Joules has been impacted because of the uncertainty of COVID, even though it's delivered during this period. And you know, obviously people have got different views about how we come out of COVID, but a lot of businesses are now trading much more normally. So we would make the assertion that, you know,
yeah, well,
Joules might trade a lot more normally, but I'm not,
well,
I'm not here to predict or forecast.
Yeah, I mean, I totally agree with you, because I think actually quite a lot of the consumer-facing stocks have actually been pretty much hammered unfairly and all been brought down on the boats. I mean, you know, you look at people like Assos, Boohoo, In the Style, you look at the Hut Group, and some of them have deserved to get beaten and to be taken out to the woodshedder, and others are less so. But frankly, everything in the consumer space has come down. So it's something to look forward to, I think, or look into for investors. Now, just turning to sort of real, again, sort of cheap as chips type stock, but they are turnaround plays. Is James Fisher and Tekmar in the sort of like or, you know, the marine services type of business. And what's quite interesting here, I mean, I suppose it's in the backdrop of COP26, so a lot of investors don't like oil and gas, and the services industry still hasn't come back as the energy plays has. Do you want to talk through sort of like why you've decided to hold your position in James Fisher and Tekmar? Because again, they're very, very, very cheap, and they have sort of like quite niche positions.
Yeah, that's been a painful experience.
Sorry to bring it up.
But I mean, at the end of the day, they've got, you know, Tekmar, which is involved in the wind industry. You know, it makes the cable connector. Wind. So imagine your iPhone 12 and the cable that goes into the back of it. It effectively makes that connector that goes into the wind turbine, and it has a 70% market share in Europe. Now, over time, there is a huge number of projects. The projections for growth in offshore wind in Europe, but also in Asia and North America, are really quite incredible. And it is quite amazing that a business with the market cap of, you know, in the tens of millions, I was going to say, I thought I couldn't remember, you know, to have such a strong presence in a multi-decade growth area and have that market share position. So I guess what the market is worried about, because we've had some stops and starts, one of the problems for the business is this is quite project led. So when those projects come through, you can have quite a lot of revenue momentum. But we've had some delays because of COVID, and I think all of that will come back. But as a small business in a mono line, you know, it only really does one thing. It does do some other things around oil and gas. Then it's impacted the company. But the company still has an incredibly strong position in its market, and also those markets have got very, very strong outlooks. And I think a lot of customers are trying to help and support that business, because it is critical. You know, you're spending billions on a wind farm and you don't have a connector. It's a bit like your iPhone, isn't it? The frustration. Well, I know it's not quite the same analogy, but you know, you've got this piece of huge amount of technology that is worth a lot of money if you don't have the right connectors. And it also matters to the overall lifetime value of that wind farm, because if those connectors go down and it's the most likely point of failure, then effectively your overall returns for that wind farm comes down. So if we're going to, you know, beat climate change and stick to 1.5%, we need wind farms to work at a lower cost. And Tekmar, a little £25 million business, is critical in that in that result. So that's why we continue to hold it. And I think it's got a very strong management team. The CEO, who's come on board to help turn the business around, used to be the CEO of Wellstream, which was a very highly regarded mid 250 PLC, which was ultimately bought out by industry.
Right. And when it comes to connections, is it basically electrical connectors, or is it actually it isn't liquid connectors like effectively the oil or the gas coming through? It's basically to effectively take the electricity which is generated from the wind farm back on shore from the offshore location. Is that? Yeah,
that's correct. And there are big global multinationals that make the cables. They are making the connector, so literally the thing that plugs into the back of the into the back of the turbine.
Yeah, okay. And then what about sort of James Fisher? Because obviously that's got a renewable side as well, but it's still been sort of like, seems to be sort of getting squeezed on all sort of fronts. But again, is very, very, if you believe that effectively, the whole sort of marine sector isn't going to go away in terms of oil and gas exploration, but also renewables, as we just talked about, and on the nuclear, which is getting more, then again, this one it's actually a pretty big business. It's got about over £500 million of turnover, but is trading at a market cap of about 200 million. Okay, it's got 180 million of net debt, but it's still pretty cheap, certainly on historical multiples anyway.
Yeah, I mean, James Fisher's got a very, very long heritage in marine services. So this is everything from tank ships that take petrol from or diesel from the big refineries in the UK round the coastline to ports to offload it. And James Fisher's been operating all sorts of areas, and also deep sea diving services, robotic services, a huge plethora of things, which include the renewable space. And there's a lot of expertise needed in accelerating the deployment of, in particular, offshore wind. And James Fisher has a big opportunity in those areas. They've had a problem in that, this is a conglomerate. It's lots of small businesses put together with a focus on, go and do, go and win business, go and build a thriving small niche company, and be on the quoted market. So you can go and buy small businesses to bolt onto yours to accelerate that growth. Now you'd go, okay, is that a good business model or not? Well, there are some interesting analogies. Halma is a business that's set up in that similar kind of vein. And that business, which is all about decentralization and empowering people to go, okay, renewables, a big area of opportunity. Let's allocate capital to that area and allow those businesses to be autonomous and have their opportunity to growth. And this is about incentivizing people in the right way. Now, I think there is an opportunity in the medium term, and the reason why we're always invested, to become a marine Halma. And there are lots of areas of regulation. I mean, the offshore wind area has lots of regulations, has lots of approval processes, and these are lots of the things that protects the returns in Halma. Now, we saw an intermediate step in Hill Smith. We see as a similar business model to Halma that we have seen as sort of an onshore industrial business making safety products for the road and infrastructure market, as working down that opportunity. And it's noticeable that both CEOs of Hill Smith and James Fisher, Hill Smith came out of Halma, but have come out of businesses with that sort of attitude. So I think it is quite interesting, and I think the new chairman that came on, James Fisher, is helping to push forward in some of the tough decisions that business needs to make that quite difficult transition. And so we are very supportive. Angus Cockburn, who is the chair, he was very successful at Aggreko, and also in the the first few years of the Serco turnaround. Now, Serco's another name. I think it's incredibly cheap, just an update today, upgrading, which it said it was all one-off. But I think that's the case of the market, being worried about numbers being weaker as those one-offs roll off in 2022, but it's being penalized for that, and I think that's very unfair. The turnaround's finished, and anyway, that's an aside. But there's as I say, there's a huge number of opportunities in the UK market, all shapes and sizes, and so you trip over them as you're talking about things.
Well, it's good that you've got they've got plenty of opportunities. I would say again, I'll just highlight to investors just on the valuation. If you are looking for sort of like a potential, sort of turnaround, then Tekmar and James Fisher both trade on less than 6 times EBITDA for next year's projections, which frankly is absolutely ridiculously cheap, given they've got exposure to renewables and offshore wind, and obviously with James Fisher with the expertise as well. So certainly good. Now, another one which came out with interim results today, and I know we talked about it last week, is totally headed up by CEO Wendy Lawrence, and they seem to be totally on track. And again, very, very cheap, sort of like just on sort of like less than 7 times EBITDA on low projections as well. So how do you see this business shaping it? Because it seems to be a real beneficiary of or really helping the NHS solve the COVID crisis last year, but also hopefully helping them solve the huge amount of patient backlog as well.
Yeah, I mean, totally had a difficult time during COVID, and that's because the NHS was under huge pressure, and totally ultimately is a business that is, the management team has spent their lives within the NHS, and they really think that they have the capability of helping to make the NHS more efficient and provide more to us, the patients, customers of the NHS in the future. And there is a huge backlog, which is really, really sad, that so many people are really have been suffering silently. And totally is really, one of its services is to effectively use NHS assets and NHS staff, but organize it, put it all in place so that they can try and accelerate the number of surgical procedures that are done in the evenings and the weekends. And obviously there's an awful lot of work to work through, but also around making sure that services are provided more holistically. So if there is the need for physiotherapy services in the community, that is another area where there's been a big opportunity for Totally deliver in its planned care service. So this includes things like physiotherapy, dermatology, all those things that are not super urgent, but are really very important to people's well-being and longer term health. And the other side is urgent care. So I mean, during COVID, Totally worked incredibly hard to make sure it delivered on the 911 service, of basically, prioritizing emergency care to people who needed to call on the services of the NHS. So I think it's done an incredible job. I think, there is an awful lot to be done. And I think Totally is one of the best placed businesses with the expertise that sits within it, but also the investment that business has put in place to help and support the NHS. So, yeah, I think it's got many, many years, obviously, unfortunately, but not just on the negative side of getting through those patient backlogs, but also the key thing is Totally is about making the NHS more efficient.
Yeah, and it does seem to be a very good sort of EBITDA margin story and productivity, because presumably if you can actually overlay on top of the growth, you start getting obviously the operating leverage and the economies of scale coming through. But if you put in sort of AI and productivity systems inside your own business, then presumably you can lift the EBITDA margins, which are going up quite a lot. Because I did see from the interims they were up by about 1% just year on year, and they're up to about sort of, I don't know, just over 5% now, I think. But there's not, you wouldn't, with the following wind, and I think you could probably get these to high single digits to maybe even 10% ultimately over a sort of 5-year period. If you do that, then that transforms the valuation, presumably.
Yeah, I mean, I don't, Totally is not going to be a super high margin business, because it's about delivering good quality services to the NHS. I think there is certainly, they've invested heavily in making sure you can deliver those services in terms of people, but also just in terms of the infrastructure. And obviously, as you build the scale of the business, that should have a benefit on the profitability. Yeah, certainly.
Yeah, I mean, I'll just point to investors that say this is a pretty cheap stock, because it's on 35p, and I know Allenby put a note out this morning. I think it's got a target price of 65p, and I actually just ran the hypothetical numbers, and if you assumed it sort of like in 5 years gets to 200 million turnover on a 10% EBITDA margin, and that's just debatable, but let's just assume it did 20 million. Put it on an 8 times multiple, you get 80p share price. So plenty of upside. It's got a lot of cash, hasn't it? So I think those
it's got a very, very strong balance sheet.
And I think those are really, sort of like with Joules very cheap, and James Fisher and Tekmar and Totally. That's a good sort of like area that people can have a look at if they really want to sort of dig through some value. Now turn into some platform stocks that you did correctly. And I'll give you credit to this, point out about 6 months ago, Equals and One Spatial. And I gave you a bit of a hard time on One Spatial, but actually the shares have done really well, and Equals has just knocked the ball out of the park. Do you want to take us through that one? Because let's start with Equals, which is knee payments, foreign exchange business on a B2B side, and they had a monster Q3 trading update plus a huge order that they've just received as well. So that really does seem to be transforming that whole that business.
Yeah, well, Paul, I don't think you gave us that hard a time, but you certainly.
I must have done it nicely then.
You did, very much so. Yeah, I mean, I think Equals is in a really interesting space. I mean, when we talk about platform businesses, is it about you construct all the costs centrally, all these services, and then you go and sell them. And Equals, I think there was nothing in the valuation for the fact that they had sorted everything out and there was a platform. This started in providing FX services to people. So this is mainly small SMEs, but I've got an FX card that they use, and there are other ones around in the market. Revolut is the famous one, which has a much bigger valuation than Equals. But the point is, Equals has built lots of services around that, including if you want to hedge your currency, they can do that for you for smaller businesses if they're making transactions, but also in terms of managing all of their costs. So if you've got people off traveling and they need to do expenses, then they have an expenses platform. You've got to remember, the equivalent services that come from SAP, Concur, they're very expensive and quite clunky. And this is really, a proper, truly online platform. So lots of incentives to doing that. And for SMEs, the big clearing banks in the UK, and this is really where the opportunity started from, really overcharge SMEs for transacting in different currencies. And that's really where the oxygen exists for Equals to construct a really strong business model. But it's also the fact that they've done it in a very, very lean way. So the point is, in actual fact, in terms of the cost structure, the clearing banks now can't really compete with the likes of Equals. Now, obviously, Equals wants to keep the margins reasonably, but also provide a very, very good service to its customers, because if it does that, it's going to grow very successfully. And I think COVID really masks the fact that this business was starting to succeed, but also, it was just getting through that period of investment. And so I think it's in a really, really strong place. And that's only just started. This is a very, very large market, and there will be other competitors. But Equals, as I said, has invested heavily. And so I think it should win its fair share of customers.
Yeah, and I think the market is sort of suggesting. I think Canaccord's the broker on it, and it's predicting sort of high teens like-for-like growth going forward. So, and that's not dissimilar to the actual market. It could obviously do. It did a lot better this last year, so we'll wait and see. But again, I'd point investors, just look at the valuation. It trades on less than 2.5 times next year's sales, and its nearest competitor listed, Alpha FX, is about 8 or 9 times sales. So again, plenty of juice in that one. I think Canaccord have got a 98p per share price target. So certainly plenty of upside. Now, just on One Spatial, which does, I think it does sort of like location management, data management sort of software, etc. Do you want to take us through that one? Because it seems as though it's a beneficiary as we move to digital twins of all things sort of physical, and likewise, the whole story between virtualization, meta universe, and also augmented reality, it seems to be winning a lot of good sort of like business with governments around the world. Well, certainly in the UK anyway.
Yeah, but this stock really sort of reflects the geek in me. You got, I think, every single buzzword I could possibly think of in there. But
sorry about that.
What One Spatial does probably, Claire would kill me, the CEO, probably sort of the most mundane part of it all, really, which it basically makes sure your data's clean and is in the right sort of place and the right sort of format. Now, that's not the most exciting subject in the world, but this is all, geospatial is all about infrastructure. So it's all about where your assets sit, whether it be telegraph poles, electricity wires, pipes in the ground, gas pipes. And to get to net zero, there's going to be a lot of investment needs to go into all of this infrastructure. So you think about Biden, who's just passed, I've forgotten exactly how much it was. I think it was 700 billion sterling, $1 billion. That's a lot of money that's going to need to be spent. One Spatial has got a relationship with government bodies, with the states, in terms of they need to submit their budgets, and all of that data needs to be in the right format. And then if you're going to go and actually invest, if you're going to go and find these assets and put new assets in, new access points or new cables. And this is all for basically, supporting whether it be telecoms networks or gas networks. This is all a requirement, and effectively it's reducing the cost of you delivering these services to your customers. You need the one spatial technology set. You can do it another way, you effectively do it manually, but the amount of work that is required now, because this data needs to be shared across many more people and many more companies that need to be involved in this whole process of investing in the infrastructure. One Spatial is at this sweet spot of having invested and had a very long history. I think I mentioned last time we spoke, I like tech that's got very long duration cycle. This technology that they've got has been around for a long time and will be around for a long time. It's just a case we're in the sweet spot where infrastructure investment really has to accelerate if we're going to deliver on any of these environmental plans that we've talked about. But even without that, all of these utilities want to make themselves more efficient, and basically one Spatial makes them more efficient. And that's just the starting point. That's just where we're at to now. When we move on a few years, it gets very exciting because they're going to start to launch applications, and we all like applications, as we know, on our phone. And it will mean if I'm the guy who's coming round to near my house to dig up the road to either put in a new cable or to renew the gas networks, effectively I will have an app that does all the planning around it about putting the traffic lights in place. Everything that sits around that needs to be submitted to my local authority. And effectively, one Spatial has a rule book for you being able to plug in and do all of that automatically. And effectively, it will do that through a portal through Ordnance Survey, and it will collect a fee every time somebody basically submits that application. And that because of the backbone of what that business does, they're pretty much the only people who can develop that and deliver it to their customers. Now, you imagine globally if one Spatial was effectively delivering those, that whole application and permitting process for doing roadworks or any kind of work on utilities. It's a very significant opportunity. And this is a relatively modestly sized business, but it's been going through that process, and this is the common process. And I know you wanted to come on and talk to, what we're looking for. We're looking for businesses that have invested in their business. They've got a very strong positioning, but you can't see it in the earnings momentum, which I refer to as being the gravy. And when the gravy turns up, basically the intrinsic value starts to match the actual share price. And that's really what the anomaly we're looking for. And because these small caps so dynamic, these opportunities constantly come up where businesses have invested really heavily, but people struggle to understand the value of the company because it's not necessarily sitting there in the earnings multiple. So we've talked about all the opportunities on the value side, of which there are many. As we move into some of these other areas, there's still, to my mind, Warren Buffett's words, not mine, about within growth, value is a key component, and that's really how much investment that the business has put in, and the size and the size and the risks of basically monetizing that opportunity. And I think in one Spatial's case, the risks of monetizing that opportunity are reducing materially from where they were a few years ago.
And that was one of your most boring stocks, is it?
Yeah. Yeah.
I mean, I was just trying to work that out from my head in terms of that opportunity, in terms of apps, etc. Yeah, if you're a sort of like a guy who's going around to maintain assets locally, and you can basically get information on that as you go to actually repair or service a particular piece of equipment at the point of servicing there and then as well. I mean, that's fabulous overlay, isn't it? I mean, that it really is to sort of like adding value. But anyway, that's something to look forward. I would say with one Spatial, again, investors have a look at it. Growth at a very reasonable price, less than 2 times sales and 11 times EBITDA next year. So does look a lot of good value. Another one which is sort of like more of, I suppose it's nearer to sort of really sort of leading edge technology or near term is Mirriad Advertising. Do you want to take us through that one? Because it seems to be a big beneficiary of the ban for cookie tracking, and it does sort of like AI based in content, product placement for advertising and stuff.
Yeah, I mean, this is where like a video or a picture tells 1,000 words. I would say if anyone's interested, go and look at their website, and they've got a really good video showing it in action, and it really is quite incredible. So this is advertising in television programs, films, soaps, and obviously it's product placement. So rather than having a 5-minute commercial effectively during the soap, during watching EastEnders, obviously not 'cause it's on BBC, but if we thought about
well, Rightmove. I mean, Rightmove, they've just run in the contract because they've obviously got a whole bunch of data, maybe even using some of One Spatial's data management software of all the houses locally. They run a location program, and the video to get it basically, or the content, tailor it to effectively what I'm looking for in a house and which location, to tailor the content to actually the individual as well.
But it is very sophisticated. You imagine, there's a few people talking in a kitchen, and you can put a packet of cornflakes on the table. You could put a can of Coke on the counter, and you can do all of that automatically. And you can do it so that it doesn't interfere with, the director's view about, the flow of the program itself. And now that really is incredibly powerful. And, they've trialed this in China, they've trialed it in the US. And they really are working very, very hard to basically get it adopted across the market. And you can see why. I mean, the feedback and the research shows that the product recognition is much, much better than adverts put in between programs. What really needs to happen is they really need to scale up the revenues. And they're disappointed a bit this year when those revenues didn't come through quite as fast as they expected. But this is an early stage business, and it's not going to be a straight line path. But in terms of the seriousness of the industry on both sides, whether you be a content owner like a Disney or a Warner, and then the actual product producers like a Procter and Gamble, who own lots of the brands we know and love, are really taking this very, very seriously. And they signed an agreement with Pepsi to look at ways in which they can really move this forward. The final piece of the jigsaw is getting it into what you call programmatic distribution. This is by way, if I'm a media buyer, so I have the budget to go and insert, I don't know, cans of Pepsi, let's say, in a program, it's being able to do that through a platform that does it automatically. Now, to some extent, they have that platform, but they have to sort of align that with the industry recognized platform. They're working very, very rapidly on that. And that really will be the lever that they can pull to see rapid adoption. So the timing of it's difficult to work out, but it is a very exciting opportunity, as I'm sure you can imagine.
Well, I mean, I used to work for Unilever, and we used to spend absolutely billions. So I say not spend, waste literally billions on TV advertising, because it was just basically a scattergun approach. Who would want to buy tea or Magnums, etc.? Half of them did, and half of them don't, or a third did, and 2/3 didn't. And that's been the biggest drag for TV advertising, radio advertising, in terms of its competition with the likes of Facebook and Google, who can do more. They can get higher response rates. But if you can give the TV guys and the radio guys the tools which Mirriad seem to be able to do, the same tools, and put it back onto the same sort of like level playing field as the digital, then that transforms my billions of dollars at Unilever and Procter and Gamble and L'Oreal, because I can then sort of like tailor that content to the individual watching it, presumably. So I'm with you. That does seem to be quite a good.
Well, I think people sort of get, I mean, we're quite supportive of ITV. I think it's got quite a very strong positioning in the market, but it can be very, very complementary in lots of areas. But also for a lot of other companies airing content, they don't have the option of displaying TV advertising, and this will be a way of really driving other streams of revenue, such as music videos. Music videos, huge backlogs of music videos. You start putting product placement in music videos. I mean, it's a huge opportunity.
Oh yeah, absolutely. Now, just moving to sort of again some reopening plays. The gym group. I understand that's a position that you have, which is sort of low cost, no contract gym operator that I think my actually 2 daughters have joined. So rather than David Lloyd, which is a bit more expensive, but I'm not sure they probably are the young professional, sort of like not yet, haven't got a house because they can't afford it, but they've got plenty of disposable income and need a place to exercise on the cheap where they can in city centres. Do you want to take us through that one? How's that going to sort of rebound?
Yeah, I mean, clearly they were impacted when they weren't allowed to open during lockdown. If your business model can't open. And I think they did the right thing because they basically cancelled everyone's subscription. So nobody was paying during lockdown while the gyms were shut.
Wow.
Because in theory you could have because this is unlike some of the other models. This isn't a subscription where you commit to a year or 18 months. You effectively give notice on a month's notice. So customers could have done that, but I think the management were very wary of, we're building a relationship with you. You want to come to our gyms. I think the key thing with Gym Group is, getting the properties that they where they locate themselves in the right place and giving people what they want. So it's automated access, it's 24/7. This already starts to differentiate them because those computer programs you can't get off the shelf to make sure you can get access. You can see when the facility is open, you can make queries, you can book training programs. So that's all there, but I think the price point is very, very compelling. I forget their average. I think it's £17.70 a month is their average fee. So, and as I said, 24/7. So look, I mean, lots of people want to do exercise in lots of different ways, but a lot of people don't want to sign up to a broader gym, as you say, that's got, squash court, swimming pool. They want a gymnasium they can go to, and they don't want to exercise in their spare bedroom. I think people feel a lot more comfortable now coming back. I think the Gym Group put a lot of procedures in place to give people comfort about minimizing any risk of COVID infection. I think they're very, very well invested. They've got the best kit for doing exercising on. Obviously, that kit is also varied. To have a home gym or equivalent would be very, very expensive. And I think it's very, very good value for money. And they now have the options, as you say. A lot of people have got flexible working. They put in a new scheme, which basically you can be a member of the gym where you might commute into, whether that be, I don't know, the centre of Birmingham, the centre of London, but also then your home gym, which might be, round the corner from you. If you live in a suburb of a major city, you can also go to without having to pay. You pay a little bit more for it, but you don't pay huge fees. I think that's a very compelling model. But there's been loads of pent-up demand, I think, for low-cost gyms, because it's not just the students or young professionals. I think there's lots of people from all sorts of walks of life, retirees who don't want to spend lots of money but want to continue to keep fit, that when you put it at that sort of price point, it encourages people to go and exercise. And I think we've all learned during COVID that we need to focus a bit more on looking after ourselves as we get older, because there are all sorts of things that can hit you from left field. And the big opportunity for Gym Group is we supported that business when they raised money because they wanted to accelerate that growth rate post-COVID. And that was because there is lots of pent-up demand, but also finding the right property assets was something that they really focused on and concentrated on, because no one wants a gym in the wrong location, the wrong place, but also that's too big a format for them to manage, and the operating costs were too high. So there's a lot of opportunity post-COVID, because there are lots of, unfortunately, businesses that have not survived COVID, and so there is lots of real estate around. So there's pent-up demand from people who want to use the product, and now there's lots of available properties that they can convert to gyms. So lots of scope for growth over the next few years.
And it does seem as though the city centres are coming back. I mean, just tell me, how busy is it in London? Because I have heard that some of the nightclubs are now starting to come back quite strongly. I think Nightclub had a trading result this morning saying that they're seeing some pretty good reopening. So I'm guessing if you can do 24/7 gyms, sort of like, that's good for the financial community, because they can do a bit of exercise at 2 a.m. when they're sort of like having lunch at when they're doing Asian trading time, I guess.
Yeah, I mean, I think city centres, the data we see from restaurant companies, other city centres are coming back. I think London has been more of a struggle because international tourists have not yet returned in the sort of normalized volumes. But I think the data has shown that sort of metropolitan cities have come back very strongly. And we saw that with Cineworld this morning, in that the UK in October was, in terms of cinema goers, was 127%. In October of what it was October 2019. Now that's partly because you had a lot of really strong releases in the month of October. In particular, no, I mean, June also came out, I think, at the end of that period. It wasn't just James Bond, but yes, I think it shows that there's lots of demand for people to come back and get out and about.
Yeah, and then sort of like just moving again to the portfolio. You've got some really long-term winners here. How do you decide to sort of like to hold your long-term winners? Things like Avingtrans, which I did notice has done has compounded more than 20% share price return over the last decade. So it's been an absolute home run, but it still seems to sort of power ahead. This is a sort of like a specialist niche engineer that does blast-proof doors and safety boxes for low-level nuclear waste out of Sellafield, and also has got sort of like a fledgling healthcare medical diagnostic, medical devices with the MRI division as well. So do you want to take us? How have you come? Do you want to take us through the case for Avingtrans, but also how did you decide to run that winner or continue to run that winner? Because it's obviously generated a lot of return.
Yeah, I mean, the thing is, I mean, you mentioned some of the things that Avingtrans is doing at the moment, but ultimately, I see sort of the Avingtrans management of custodians of small industrial businesses that might have lost their way, and these are essentially good businesses, but they need some really good management to come in, refocus them, and to get the people within those businesses to really succeed. And they call it their sort of buy and build, but pie strategy, which is pinpoint, invest, and exit.
Yeah.
So they don't necessarily think they're going to own these businesses forever, because once they've got to their, they've done the turnaround, this is what their management really focus on. But it's more than turnaround. That's the whole point about pinpoint, invest, exit. I mean, that is what we're trying to do in terms of our whole equity strategy, is pinpoint a really good business, watch that business invest, and then see effectively the share price go up. Now, we don't necessarily exit, but if the market, overvalues it at some point, when we can churn into other opportunities because the market is very dynamic. And they do the same things. And I think the thing with Avingtrans is why we continue to follow it, is they continue to find great businesses that they invest in with there's lots of opportunity, and they will realize those. So they realize those, that generates cash that they can then go and find new exciting businesses to invest in. And I think there is quite a big opportunity at the moment that has been a very slow burn. I think, going back 5 or 6 years ago, when we really got involved in Avingtrans, it wasn't really something they mentioned. They were sort of, the last 2 minutes of the meeting, they just go, well, and there's this bit which we won't talk about. And it's really coming to the fore. And this is really a set of businesses that allow them to effectively develop compact MRI. So we all, I mean, I have had an MRI scan, unfortunately, quite some time ago, but, they're a massive machine. They've got their own room, the shielding for the person operating it. There's a lot of kit that sits around that. They generally operate with liquid helium. So you need a liquid helium source to cool the magnets. It's a pretty big thing, but there are lots of ways where you might have problems with your knee joints, your elbow joints, problems with your fingers, where a relatively small format still would be really helpful in your diagnosis, but also for animals. So, there are a lot of veterinary practices would like a compact MRI scanner. Now, the MRI is pretty much dominated by 2 large players in the world, GE and Siemens, and they're not really in this space. And they have developed through having bought lots of little small businesses that have all got the expertise you need to effectively develop a compact MRI, and they have all of that now. And so in the next couple of years, as long as they get through approval, then they will have the world's only compact MRI scanner. And that potentially has a lot of value sitting within it. And that's, that's a reason why I'm still invested in Avingtrans, because one, that big opportunity still sits there, but that's not the only one. There's a list of half a dozen businesses within Avingtrans, and when the opportunity has finished, they will look to exit the business. And there are lots of people with lots of cash who want to buy really high quality, really well managed assets, and that's why Avingtrans can continue to cycle that cash flow. And sky's the limit. The only other sort of similar model of its type in the UK is a company called Melrose, which many people might have come across. But Melrose Industries, which started off being a relatively modestly sized business, is now 7.5 billion.
That's not a bad return either. Yeah, I did.
No, I'm not saying, be clear, I'm not saying Avingtrans can be 7.5 billion, but I'm just saying the scale at which you can operate this mechanism can be quite large.
Well, you shouldn't say that to the CEO, Steve McQuillan. You should just sort of say, yeah, yes, Steve, it should be 7.5 billion. Just interesting for investors, the shares are currently roughly around about just below £4.50, trading on around about 11 times next year's EBITDA. And I mean, I think when I run the numbers on the sum of the parts of all those interesting opportunities, I get a sort of fair value of about £5.25. But I know the biggest shareholder, who's Christopher Mills from Harwood Capital, who's an extraordinary life sciences investor. He reckons that if they do actually get the small form MRI scanner from their Magnetica division to work, then that'll add another £5 plus put onto the share price. So you're right, there's plenty of upside to run that winner, that's for sure. Just moving now to sort of like recent IPOs, we'll go through this ones you've recently invested: Kitwave, Microlise, and Victorian Plumbing. But just before we do that, can you just quickly what's your view on the IPO market? Because when we last spoke, it was pretty red hot, and then it went through a quiet period, obviously during the summer. How does it look at the moment in terms of the sort of? Because I mean, there's been a lot of IPOs this year, but they still seem to be happening. So, what's your view on the IPO market in the UK at the moment?
Yeah, I think it's calmed down. I mean, as we talked about at the start, there's lots of uncertainty. I think the yield curve has worried people. I think, you still got some concerns about the pace of economic recovery, but also I think, things got too hot. And when things get too hot, people have a bad experience of the IPO market, and that tends to dampen demand for a while. I mean, you can still IPO a good quality business at a fair and reasonable price in the market. But I think, there was some excess going on, and obviously there's a lag. The corporate financiers promise a company what they think they might be able to IPO it on, 6 to 9 months before it happens, maybe even a bit longer than that. So, you extrapolate that hot market where it did get overheated, and you've got this disconnect between what you've kind of promised the company and the management you can float the business at. This tends to be at the larger end, where it's syndicated lots across larger banks, which we tend to stay out of. But I think you've got quite a difficult period in forecasting. So because you've got, COVID coming back, there's quite a lot of volatility, which creates lots of opportunity, but that's obviously a harder market to come and IPO your business in, because it's harder for you to say, look, I think this does offer fair value, because I can tell you that we'll guarantee this is the number we'll do for next year.
Well, there's one I think you've invested in, Microlise, which is it does software, I think, telematics software for sort of like helping the trucking industry and HGV industry and delivery vans to sort of like better productivity and stuff. And it was, I think, it IPO'd in August at 135p. Shares currently trade at £2. So well done there. But I guess that's benefiting, is it, by that they're helping effectively the whole industry with their supply chain issues at the moment?
Well, I think that's what got the market very excited about the shares. I think that the management would say, look, yes, it is an opportunity, it's not a hindrance. I'd say in the very short term, obviously those businesses were running around madly trying to fulfill everything rather than focusing on making themselves really efficient. I think once that's washed through, and that is washing through, there is a big opportunity. I mean, the reason why we invested is because this business has already proven its quality, and it's got a 60% market share in the UK. But it's got a new optimizing product. So it does do telematics. Telematics is actually quite a commoditized product in that area. What is interesting is a lot of the software that can sit around that can tell you about your driver, about safety, about rerouting to make it more efficient, which the telematics you need as a platform. But really it's around the optimization software that sits on top of that. Now, the value of the optimization software to their customers would be 3 or 4 times the software that they currently sell. And that product has only really recently been launched as they came to the market. So we really like that position. You've overinvested in the business. You've invested in new products you haven't even started selling, but you've got a really strong customer base. And then the next opportunity, which again, we like British companies that have established their business model in the UK, but it's applicable in Europe, in the US, in Australia. and they have won some customers in Europe. They're looking to go to Australia, and we may well see some bolt-ons that will help them accelerate that process to access those markets. So you've got layers of opportunity of growth, whether it be new markets for the selling their current products. You've got these new products coming in, and the scale of these new products are material to the size of the business. So one of the issues, this is where you take the sort of the Warren Buffett sort of meaning of value, because if you look at the earnings multiple of the business, it's quite expensive, but it is cash generative and it's done all of that investment. And now it's just really establishing its route to market, and you'll see all of those benefits. I would expect, if they can succeed in making those sales, come through in terms of the value. But the value really sits in our view on the risk of monetizing what they've already invested in the company, which obviously we feel is obviously substantially higher than where it would sit today, and that's really because of the success they've had with their customers in the UK market. And then that's on those higher growth names, those the sort of the basic rules we employ in terms of establishing value.
Yeah, and I guess also it could be ultimately it could be one of those high-tech sort of industry sort of like, niche software players that's taken off the market by private equity or a trade buyer from overseas who come banging on the door.
I don't list I think you're alluding to Blue Prism that we come, but I wouldn't say this will, because the founder owns 62% of the company.
Yeah, okay. Oh, okay.
So
okay, well, let's just follow that train. Blue Prism, give us a view, because you were right. I mean, the shares were about £9, and I know they've sort of they've ticked up on sort of acquisition, but they're not massively, sort of bid up at the moment. But is the transaction, is it now definitely going to happen? Is it by, I think there's a couple of private equities sort of sniffing around, isn't there, or something?
Yeah, I mean, look, it's very difficult for me to make a comment, Paul, to be honest.
Sorry, okay, no problem.
But look, I mean,
just broadly,
there was a lot of value I felt there, and there has been a disagreement between some shareholders and the board of the company between where fair value sits and the risks on delivering that value. We will see what happens, but I can't comment on the situation.
Well, anyway, it was a very good call, James, for not selling, that's for sure. Now, moving to a couple of other IPOs, Victorian Plumbing, which I think is a sort of like a online distributor, and I think has its own products in the sort of the all things bathroom associated. Now, clearly online has just done brilliantly over COVID and will continue to. It's accelerated that whole business model. But equally, you've got a lot of people who have put in their new bathroom. Has it brought demand forward? How do you see that one sort of like moving forward, Victorian Plumbing?
Well, I think it's interesting, because you're one of the closest comparables you'd say in the market is a business like Howden. Now Howden, you'd argue that the kitchen market has grown slightly. I wouldn't say that there's been that much pull forward in the same way in bathrooms, but there probably has been some of that. But really, this is about a market share story. This is about the fact that Victorian Plumbing can offer you the best selection of products, the best availability at the best price. And they can do that because they have a very low cost model. They also have spent a lot of time designing their own product set, which are very high quality, and also showcasing them with the best brands across the world. And as an online business, it is really great for availability. Who wants to go down to a physical site on a Saturday, or your builder have to go on during the week and find product sets not available? Now, Howden is a physical business, but it built its whole business on one of the key tenets is great products, great value for money, but also great availability. And I think in this market, that availability point is incredibly important, as well as depth of product offering. And I think it has all of that. I mean, it is a bit painful. I mean, this is back to the difficulty of IPOing a business at the moment, when there has been a COVID effect, either positive or negative, and the timing of when that comes back. The reality is Victoria updated the market and upgraded its EBITDA forecast by 5% for the year. So, it came to the market and did everything people expected it to. What surprised people was the revenue growth was a lot slower over some of those summer months. And I think this is some of the volatility that has been introduced as you're trying to forecast everything. Now, I think the strength of the management team, that they had some levers to pull. But the reality is, I think they're doubling down on investment. So, they've not stopped investing in customer growth, which is what would worry you about their positioning in the market if they hadn't done that. So I think they feel they've done everything they should have done. The market is very nervous around, the fact that the sales declined for a very short period of time. We're talking a few months. I ultimately believe in the medium term, it has got a very strong positioning in its marketplace because of all the attributes that I mentioned at the start.
And just more broadly, with the sort of the health of the consumer, obviously the consumer is sort of 70% of the economy. How much does it depend on sort of house prices? Because a lot of people sort of like worry about the wealth effect. Because let's be clear about it, over the last 12 months, people's house prices have gone up by double digits. They're sitting on a lot of sort of like equity in there. Obviously, the stock market's gone up as well. And that sort of like made people a bit artificially sort of like, flush with money that they obviously want to spend on overseas holidays next year. Well, certainly everybody in London probably does. And likewise, sort of like energy prices are going up. I mean, I just got the new bill from Eon, having had my provider just gone bust. It's double the price that it was only, I was paying. So, it's a sort of the health of the consumer sort of like, would it be impacted if house prices took a bit of a bath? And certainly if you get sort of rising bond yields and mortgage availability of the cheapest deals is certainly sort of like dripping off a bit. Is that a concern to watch out for?
I mean, it's always a concern because you're entirely right. I mean, the UK consumer makes up the majority of the economy, and house prices are, everyone's largest asset, and they have a mortgage on those, and the wealth effect about how confident you feel about spending is quite highly tied into that. I think it was pleasing that it feels that the Bank of England's on the front foot in trying to guide on, that they will go early and be ahead of the curve in terms of interest rates. And that's historically has been quite a strong indicator that if the central bank is ahead of the curve, they might get their timing wrong. And there was, people squealing slightly in terms of they're indicating that view. But yeah, look, as a result of that, the market looks relatively benign. There is cost inflation for the house builders, but there is reasonable house price inflation. I think the margins that on some of the mortgages can probably come in a bit more, which will offset any interest rate rise. I think an interest rate hike of them being ahead of the curve will be relatively modest, and so it'll cool the market a little bit, but they'll want to gently cool it rather than having a bath, to use your phrase. Obviously, if that was to happen, then it would be very significant for the UK economy, but I don't think anyone worries about that at the moment. I think everyone feels that people are on the front foot in terms of, if house prices were to ease off, it'll because sentiment comes back a little bit. But the key thing ultimately to the health of the consumer is the employment market, and the employment market seems incredibly strong at the moment in terms of the number of vacancies and the number of people unemployed. So I think that's the backdrop that's going into 2022, and that will support a reasonable house market. But I think the fact that the house market isn't necessarily roaring away anymore and people are basically being a lot more cautious about it, I take as a huge positive for the wider economy being stable, and ultimately investing in small and mid cap. Everything we've been talking about for the last hour is about businesses carving new niches, taking market share, driving their business forward. And as long as there isn't a major recession, all of those businesses can do that. It's not reliant on the economy roaring ahead for those businesses to succeed. And I think that's often misunderstood about small cap. I think a lot of people decide to come into it when they want a proxy to the UK economy, when they think the UK economy is going to roar ahead for a year or two. But if the UK economy does that outside of a bounce back, it tends to end in tears. I think we're not in that scenario at the moment, which I think almost adds to the fact of why I think UK small and mid cap is even cheaper than and sort of a better investment than if you had got an economy that looked like it was going to roar away for a couple of years.
Yeah, I think you're absolutely spot on. I was just playing devil's advocate because my base view is such that actually all the central banks can't increase interest rates because their governments are so steeped in debt that they need to reduce the net debt, the nation's net debt to GDP profile, over a long period. And they've already signaled they're going to run it hotter for longer. They just don't want it to get out of control so it becomes a real problem. But I think as investors, I'm with your strategy, stay in quality with pricing power to be able to take, if there is an environment of 3 or 4% consistent inflation going forward, to get that GDP, to get the net debt to GDP back in balance. Because I actually think that's the biggest thing that the central bankers and the governments are going to drive it. But anyway, that's my personal view. So just coming on to the final one, Kitwave, which I do believe is a distributor. It's a bit like the old Booker's business, I think, that Tesco's took off the market, that it distributes sort of impulse products and chilled and frozen to all the sort of like small stores and convenience stores and to people around the country. What have you seen in Kitwave?
Yeah, I mean, Kitwave, it only came to the market in, I think it was May. And again, this was a business that was impacted by COVID, but we'd been involved in Booker. And I've been involved in Brake Brothers. They're the two dominant players in the market.
Okay, yeah.
But, there's still huge fragmentation outside of those two names. There are lots of businesses that have been successfully set up by people. And at some point in their careers, they want an exit to those. But also the fact there is huge benefits to scale here. So, Kitwave has just finished a huge investment in I think it's 700,000 square feet. I might have got that wrong, in Luton. So they've put all the investments in, and they've said their stated strategy is buy and build. They can win market share by delivering great service, but it's got a very well invested business. It's got the capacity, and it's made no qualms that it wants to go and pay fair prices for small businesses, and it gets some significant benefits from those businesses once they take them on in terms of procurement cost savings. Effectively you are buying wholesale, lots of these, everyday products, and you're delivering them even as small as £100 order value to tiny little shops across the network of shops across the country. From reasonably medium-sized businesses to really small corner shops, especially particularly frozen food, chilled foods. These need specialist handling. You need to have the right infrastructure. You need vans with chilled and frozen compartments. So there's a lot of opportunity, and the network effect. Imagine it's a bit like a milk round. I mean, they always refer to it milk round. These kind of businesses. Yeah. You've got your van, you're leaving your depot. You've got your scale of your depot. You can put the M&A in, but then you're going to go and visit a number of shops. Once you can market to those shops, and you can visit 10 shops almost sitting in a row to simplify it, you become a lot more efficient, and also you're paying less for your products, so you can offer your customers better value. So it's benefits all round really for the smaller customers, and ultimately you're squeezing the big multinationals to get a fair price. So yeah, it's a really interesting, but again, a bit like One Spatial, you might go, well, it's a bit dull really, but I think that's what's exciting about it.
Well, hey, the valuation of it doesn't look that dull. It's only on sort of 11 times, 12 times PE for next year. So again, another terrific sort of value play. And I guess given Tesco's bought Booker's, it must mean that some convenience stores are looking to move away from Booker's and will put more business towards those independent, because they don't want their data being in the hands of Tesco's. I mean, strategically, it doesn't make much sense, does it? So you'd have thought.
No, that is another component of the story, which yes is of considerable benefit.
Yeah. All right. Well, thanks very much for your time, James, and look forward again to sort of touch base with in 6 months, and hopefully we'll have that whole thing about sort of a Blue Prism will have unravelled by then. But anyway,
we can catch up on it then. Yeah.
Yeah, I'll be watching that with significance. So have a great Christmas, and speak to you in the new year. Thanks, James.
Same to you. Thanks, Paul.